Lachlann Tierney, thanks for joining us today. How you going, mates?
Hey, Greg, good to hear from you. Yeah, pretty good. The sun's shining. It's not so bad.
Well, good to hear. Good to hear. It's not too bad down there in Melbourne. Reason we're chatting today, I mentioned on the Insider on Monday that I'd have a look at the Square Afterpay deal in a bit more detail, and I thought, as one of the co-editors of Exponential Stock Investor, which specializes in looking at these high growth companies, you'd be the man to talk to about this, because when an old value investor like me looks at this type of deal, I can see the rationale, but I really struggle to see how to make the numbers work. So good to get you on board and explain, hopefully explain why this deal makes good sense, because I know you're a fan of it. So perhaps you could just sort of give us a brief overview of what went down, who Square is, and why that's a good thing for Afterpay, which clearly the market has decided it is, given that the stock's up quite strongly today on Tuesday when we're recording this.
Well, it's an interesting one, Greg. So it's an all stock deal. It's based on Square's closing price of 247 US on 30 July, which basically means they're paying around $126 Aussie for Afterpay shares. So that's about a 36% premium. So Afterpay shareholders will probably be delighted at this. Some of them thought it could have gone to the moon even harder, but really, I think this is a good deal for Square, and it's a good deal for Afterpay. Jim Cramer, the mad money guy, thinks it's absolutely rubbish, but I don't put much stock in what he thinks. I'd also note that Afterpay shareholders will own 18.5% of Square shares after this deal. And what's also going to happen, and this is the real kicker, is that Square is going to have a second listing on the ASX to allow for Afterpay shareholders to basically dispense or trade their shares in Square more easily, because there's frequently that sort of international share barrier. So that, I think, is the real interesting thing. And what you might see is Square shares on the ASX start to do really quite well, because that retail crowd from Afterpay will realize, hey, this is the new growth payment stock I want. And of course, Square's the Jack Dorsey Twitter founder's sort of brainchild. And Square is a weird one. They are probably best known for their hardware, which is sort of this little white square FPOS machine, which integrates really nicely with a lot of point of sale systems at retailers. And that is sort of what their brand is known for. But their cash app, it's sort of like a payments app, and it's verging on a banking app in that it lets you buy cryptocurrency, buy stocks, move money around. It's incredibly easy to use. And that's part of the reason it's such, I guess, hyped up deal, is because it's a sort of a meeting of two businesses that really cornered that younger money demographic really well. And there's a lot of potential. The jargony word synergy gets thrown around a lot, but basically the same young people that are using Square are probably using Afterpay, and the overlap with those two customer bases is sort of what's justifying this big deal.
So is that really what it's about? So, for example, Afterpay provides, I guess, a technology platform to allow people to buy now and pay later.
Yeah.
Funnily enough, and obviously there's a lot of competition in that space. So Square have obviously seen something in Afterpay to differentiate it from a lot of the other competitors out there. Do you think it's purely the numbers that are using Afterpay, given its probably first mover advantage? It's got a quite a big user base, and Square can see the benefits of absorbing those two, I guess, customer bases in together and using each other. Is it as simple as that, or is there something more to it?
There is the scale side of things, but the other thing that Afterpay has been particularly working on recently is a banking as a service model, which is they've acquired via Westpac. So that was an update which came out just before their acquisition, which means that Afterpay was looking at sort of piggybacking on Westpac's banking license and providing, I think they were offering around 1% on savings, which is better than you can get in some other places. So there's the scale side of things for the acquisition, but there's also Afterpay's sort of increased level of partnerships with traditional banking, and I guess a sort of a back-end tech stack, which is very appealing. They're looking at sort of ways of monetizing merchants in terms of advertising. So it's not just the sheer scale of their customers. There's a lot of reasons why Afterpay was an attractive acquisition for Square.
Now, one of the criticisms that I've got of both these companies, and I've written about Afterpay a number of times before, just really challenging it from a valuation perspective. And I get that myself and plenty of investors like me just don't really understand the multiples that these companies are trading on. Now, let me just show you based on FY22. So we're in the 2022 financial year at the moment. Square trades on a P of 309 times. Afterpay trades on 428 times. Those numbers are going to change, obviously, with the merger and the potential synergies and benefits from that merger. But just to give you an idea of what the numbers are, and in FY23, with more growth coming through, you've still got Square on a P of 182 times. And Afterpay on 166 times. So, and then when I look at the profitability of these companies, so the return that they're generating on shareholder funds, you've got Square generating forecast in FY23 35% ROE, which is pretty solid, but Afterpay is only 11.5%. Now, once again, when you get scale, that changes the numbers for these business models. So I get that that's going to increase with the merger, but still we're looking at really, really big multiples here. So is this just another case of US tech stocks, investors looking at a very, very long growth runway, forgiving the fact that they're not going to make a decent amount of profit for a long time, but as long as they grow top line revenues, you're going to see these multiples for a while? Or is it just an example, or I know probably know the answer, or is it just an example of tech bubble valuations?
I've got sort of 2, maybe 3 points here. So the first point is about market capitalizations of the biggest 4 banks in the US. And then I'll sort of follow that up with a sort of broader point about, I guess, markets going to crazy town and not even relying on dividends anymore. There's just too much liquidity and capital, and that's a more macro chat. But I've got the market capitalizations of the biggest 4 banks here. JP Morgan in the US, market cap of US 157 bill. Bank of America, market capitalization of US 300 bill, 320. And then you've got Wells Fargo, another huge bank, US market cap of 180 bill. And then Citigroup, which Square is closing that gap with them, they've got a US market cap of 140 bill. So, I mean, if you look at it from an earnings perspective, yeah, this is reaching sort of peak absurdity. But if you look at it as maybe a market cap question, Square could eclipse some of these big banks in the long run. And although they have very low earnings multiples, these banks compared to Square, it's sort of a trade-off between the sheer scale of these big banks and where Square could just steal market share from them in the future. And a lot of it comes down to demographics again, because imagine if Square starts doing home loans to this younger demographic. That's these big banks' worst nightmare. And then if they could manage to sort of upgrade their offerings, all of a sudden that earnings multiple for Square would come down quite quickly. And then that earnings multiple from Citigroup or Bank of America, JP Morgan, Wells Fargo, then they're competing for customers, and it becomes a very different ballgame quite quickly in the next 5 years, sort of depending on where technology and product offerings go. So, it sounds wild to say, but I'd almost say Square is undervalued at this stage. In the
You're
Aussie
looking at
market,
that.
for example, Xero, the software accounting company, they that one stage a while back, they were trading at a multiple of 1,000. So maybe with so much revenue behind it, maybe Square is not the most absurd company given its reach and this is a profitable company. It's not even hemorrhaging cash like Afterpay once was. So those are my sort of like pushback points towards that. And then of course we can have this more macro chat about whether the market even cares about earnings anymore because there's just so much liquidity. And that's all central banks. So it's a really complex question. You have to sort of put the two together. And when it comes to Square, it's just easy to use. It's everywhere. And you can buy Bitcoin on the platform in a heartbeat. And that's what appeals to the younger generations. I mean, Square derived about 2.7 billion revenue from Bitcoin alone last year, which is more than their transaction-based revenue, which is their hardware, which is their FPOS machine, basically. So it's a really tricky question to answer without thinking deeply about not just the current state of the market, but also where technology is going and where product offerings could occur in the future. So those are my two sort of broad points.
Well, I think just to expand on something you said a little bit earlier, if there was any justification for it, I can see the point of both of these companies really appeal to a demographic that has grown up in a different environment in terms of affordability of assets, in terms of like just lifestyle. And you've got the younger generation, and it's probably more in line with your generation, Lockie, that are reasonably income rich. They've got access to jobs even from a young age, whether they're part-time jobs or whatever. But the idea of owning assets and owning property and things like that just seems so far away from them that it's almost like not an option. So you've got, say, for example, Afterpay, where people spend quite freely and live paycheck to paycheck often. So it's a perfect app to say, well, look, instead of just putting a chunk of money down to buy one thing, pay for it over a month, with consecutive paychecks. It's a similar thing with, by the sound of things, with Square. It offers younger people transactional ease rather than having to go into a bank, fill out a form, lengthy process of opening up a bank account. And just speaking about it doesn't feel like a big deal. But if you look at this as a demographic movement, once this younger generation moves through the demographics into a more of a middle age, they're going to have grown up using these things, and the big banks are going to be left on the outside because they're not going to have that natural cohort of customers coming in and using their services. And like you said, if Square, for example, can start offering mortgage-related products or an ability to get into the mortgage market or the housing market down the track, then banks are going to be increasingly isolated. So from that perspective, and this is where I asked the question, how much of a runway is the market looking at to finally seeing these companies justifying? Because you just went through the market caps of the big four banks. It's worth pointing out that Square's market capitalization is 125 billion, which is only a little bit below some of those very large US banking stocks. So it's really up there challenging at the moment with a fraction of the profits. But I guess that could be a very different story in 10 years' time, right?
Yeah, 5 to 10 years. And the other thing I was going to mention there was that Square, interestingly, it's sort of just thriving off the fact that the banks shot themselves in the foot. If you've ever, encountered a credit card these days, the banks had this sort of competitive moat where they're the only people offering credit. And the APRs on some of these credit cards are so onerous and miserable that that's part of the reason buy now, pay later even came about, was because young people just learned to hate credit cards because the banks gouged their customers with these crazy APRs. So it's not just that
When
there's
you
these
say APR, do you want to
technological.
explain what you mean
Oh,
by
sorry.
APR?
Just the click the bank's taking every year on your credit card, 20, 30, 40% sometimes. So it's not just that there's this technological wave. The banks have actually sort of maliciously gouged customers for decades now, and I think they're ripe for the taking in terms of market share and customers.
So do you know what
that.
the difference? Do you know what the difference is, for example, with the way Square would charge on processing payments, for example? So when merchants, and this is one of the core markets for Square would be merchants, right? They go into small businesses, they set up, and I've been in there, I buy coffee sometimes, and you put your phone on the little white square. And so they're clearly using the hardware and the back end payment system. What would be the difference, or what would be the motivation for a small business to use that type of setup rather than one like an EPFOS system that goes through the big banks? Is it smaller fee take?
I imagine so. I had a buddy that used to roll out these Square platforms in retailers, and for a retailer of decent enough size, I think it's a combination of just ease of use, easier integration with point of sale systems, faster transaction clearance times. I can't give you a complete rundown of why it's better, but just the fact that you're seeing it more and more is probably a sign that it's got a competitive edge over, say, a NAB terminal or a Tyro terminal, or it. And also, it's just aesthetically pleasing. I mean, you look at the little white square and you think, oh, that's a nice place to put my money.
You can take my money.
Yeah. So, I mean, it's sort of like if Apple designed an FPOS machine, and you can see how that aesthetic is just part of their overall appeal as a company. And I can't give you an exact breakdown on the competitive edge, but I wouldn't be surprised if it significantly undercuts the merchant fees that these big banks are taking.
Well, you mentioned Apple. I mean, they're moving into the buy now, pay later space as well, aren't they? So it's clearly been identified as a major growth area. Now, going back to my earlier point as being a sort of taking the value invest approach to all this, I just see this as a glorified lay-by service. So I really struggle to see where all this growth comes from, unless there's a movement for people to say, all right, bugger it, instead of buying it outright, I'll just essentially use these companies to affect my working capital. Because the way you talked about credit cards and the fact that the younger generation don't like them, the way I use my credit card is that I use it as a working capital facility for my weekly payment. So I will put stuff on credit. I will make sure it's paid off at the end of the week. I use the points previously, before everything shut down and locked down, maybe buy some airfares to visit family or go on a holiday. And that would justify the $300 or $200 payment each year to have access to the card. So I guess you could say that this is just another form of using some other company's access to credit as a bit of working capital for your own situation.
It's maybe there's a deeper philosophical point here about the younger generation being more tied to sort of fleeting experiential things as opposed to the tangible owning a house, the white picket fence, that sort of thing. I mean, I'm guilty of it too myself. I went to a nice French meal the other night, and I thought that was the best use of my money I could possibly imagine. And then
you get too many people arguing with you on that.
and then there's the sort of other philosophical point about the market is generally, and this is maybe the value investor, macro investor thinking, is that what you're doing when you're buying a share or an equity is you're getting a share of a future stream of revenue, but it's gotten to such a stage in the market now. I'm willing to say that is no longer the core justification. We've become completely divorced from, and it's absurd, it's crazy, it's not the way things should be. But since 2008 with the GFC, it's almost as if central banks have decided to say that's no longer the core reason for investment. You may now be investing based purely on some future dominance of the market, as opposed to whether or not they can derive a significant amount of earnings from that market. So it becomes very complex at that big philosophical level. And central bankers have sort of forced our hands. I had a value investor talk to me the other day. He just called it crazy town. How do you value these cryptos? How do you value these stonks? And part of it too is, yes, it's psychological, but you can also benefit from that psychology if you're clever about it. And a lot of that, for me, with the exponential investing strategy is sort of determining what I think the likely future looks like, not so much can I get a portion of the earnings of that company once they become profitable. And it's successful for our strategy at the moment. And maybe you shouldn't be doing this for your whole of portfolio, but it's a strategy that works for speculative capital. I would definitely say that.
Well, I think you've just hit the nail on the head. The central banks have turned the market into a speculation rather than an investment. I mean, there are plenty of things around that you can invest in, but they're the old traditional low growth businesses that the market doesn't seem to be too interested in these days. So, well, Lachie, it'll be interesting to see what happens when Square does list on the ASX and how the speculators decide to treat it. I think I'll be happy standing by and watching. But all the best to you young fellas chasing the stock and seeing how it goes, and maybe earnings don't matter anymore.
Fair enough. I mean, we did tip Square once upon a time, but we got stopped out of it. So I think we learned our lesson there. And yeah, I think Square
stop losses are for old people, mate. Don't use stop losses.
Well, risk aversion in the right places is sometimes a good thing, Greg.
Absolutely. All right, Lachie. Well, thanks very much for joining us today, mate, and clearing that up. It's certainly given me a bit to think about and helps me to understand what that transaction and all the fuss is about. So I appreciate your time, mate. Thank you.
It was awesome, Greg.
All right. Thanks for listening, everyone. We'll catch up with you again next time.